Hello, everybody. This is Jack Campbell, Keller Williams. I'm super excited to be on the line today. We've got Garrett, who is a very seasoned mortgage veteran, having regular originations for him. I know he does a ton, mostly because of the systems that he's got in place to support him and the volume of transactions they do. $56 million in actual closings for last year alone, which puts him in the top percentile of all San Diego mortgage originators. And then I happen to know firsthand very well Julien, who is on our team and also, rock star in his own right. He's a top producer. In fact, for agents with teams, he is the single largest producer in our market center. So certainly making his own marks there too. But we're here today actually to talk about the mortgage industry a little bit and how that's really kind of affecting consumers. We hear a lot about, I read articles online. Obviously, we're in the real estate business, Garrett. And we're hearing a lot of banter about, what things are going on in the mortgage market that are not normal. And we're hoping that maybe you wouldn't mind elaborating a little bit on, what you're seeing at your end that's maybe what's happening.
Mm-hmm. Yeah. Just to kind of give a big specific, we're just seeing a big slowdown and a freeze of what I like to call a freeze of assets in our marketplace, or at least from the lending side and being able to provide a buyer financing. But that doesn't mean that it's frozen for everybody or that it means that we can't go out and purchase homes. It's definitely still a good market to be purchasing homes. It's definitely a time to still be purchasing. The conforming space is still available, and the government space for loans is still available as well. The jumbo space we're going to get into a little bit, it's going to be different, but that's because there are different types of investors in the jumbo space. When it really comes down to where we're at currently, the mortgage market, let's bring you back to a little bit of what happened in March. The beginning of March, the bond market hit the ultimate low, which put us in a position as lenders to be able to refinance a good amount of people. There's about $10 trillion worth of mortgage outstanding debt in America. As of March 1st, or the first week of March, that put about 70% of people in that market available to refinance. So that put about $7 trillion worth of mortgage debt available to refinance in a market or in a mortgage industry that's only ever done $1.98 trillion worth of loans. So we became over capacitized. We had so much demand coming into the mortgage industry that we weren't able to meet all of that. So simple supply and demand. We had to raise interest rates on the refinance side. So if you hear that rates are possibly have gone up a little bit, that's because the mortgage industry as a whole had to raise those industry rates to meet demand. But on purchases have still followed the market. So a mortgage interest rate on a refinance right now is about 0.5% higher than where the purchase mortgage interest rate is, because purchases are still needed in this industry for fulfillment and for new loans. Refinances are not. We know where the market is. We don't really need that many more refinances, but we absolutely want to be helping people get into homes and new homes. So the interest rates on refinances, on purchases, are definitely still lower.
Wow, that's amazing. So have you ever really, I know there's always been an incentive by lenders because purchase loans are a lower risk than refinances, technically speaking, as far as the numbers go. But has there ever been a time that you've seen this big of a discrepancy in pricing between refi and purchase?
Never this large, at least. We've seen it a couple of times with, like you said, when there's risk to a certain type of product or a certain type of loan. But this volatile, absolutely not. And the amount of movement, this is happening on a daily, hourly basis, where we might be at a level in the morning that we're here and we're already a quarter different by the end of the day. So it's very volatile in today's market.
Wow, that's interesting. So I know you mentioned that it slowed down. It sounds to me like when you say it slowed down, did you just mean the purchase side of things, or do you mean because it sounds like there's more refinancing business out there going on than could ever be imagined?
There's a couple of things with that. So refinances have to be forced to slow down by the mortgage industry because of how much came in the first week of March and the second week of March. So that's when the mortgage industry actually raised those rates to stop the refinance origination coming in. So that's the first thing that happened. Then mid-March, we had COVID problems here in California where we had to do a big consumer shutdown. The government and the Fed decided to stop people from going to their local businesses and here in California. What that did, right, is that stopped investors from holding and funding loans. What that means is they don't want to pivot or make moves in the market, right, and fund the loan for the lender until they have the data on when the government's going to release and let consumers back into the market and know how this market moves. That's when I kind of want to reiterate and ask. Can you ask that question again, Jack?
Yeah, well, I wanted to get an idea really of the most. Yeah, most importantly, I guess I'm trying to understand really how does this affect the consumer. So at the end of the day, what has changed in the process of how a consumer would go about getting loans today versus what was the case even just 3, 4, 5 weeks ago?
Mm-hmm, mm-hmm. Ooh, that's a good question. Because I mean, there's differences now. I mean, to be honest, in just you, me, and JR's conversation, there's a difference in the conversation that we're having with people too. In reality, is when they're calling right now, we're getting a lot of calls. Is this a good time to be buying? That's the types of calls that we're getting from a lot of people. Or is this a good time to be purchasing? Is this, what type of market are we in? And It really comes down to us when we say, rely on your expert for that piece. But from an industry standpoint, let's talk about San Diego in general. There's definitely more demand than there is supply still. Rents are still going up. So we're having a big picture conversation a lot of the time right now. And this market, when it comes to purchase, that we've never had to have before is educating, do we think that home prices are going to fall? Well, if they do on a national scale, how does San Diego get affected? Those are the questions that we're answering right now in this type of market these last 2 weeks. When it comes to how to get a purchase, nothing's changed. Nothing's changed. If you want to get a purchase and you want to buy a home right now, you need to get educated still with your real estate partner and your lender. You need to go through the application process, call us, go through a full credit analysis with me, go through, let me understand your assets and let me understand your full financial picture so that we can determine, right, in this market, does it make sense for you to pick up where you're at and make that next change? Nothing's changed with that. We still got to go through the whole application. We got to get your credit. And now we just identify what product is available in this type of volatile market.
Yeah. And so, Garrett, go ahead.
I have a question. You mentioned conventional markets and I guess markets that fall into the space that the government backs. Can you talk a little bit about that? And then what differences, because I heard that there's a few different qualification changes that we're starting to see even in that space. So can you expand on that? And what is a conventional market? What other markets that the government are backing? Just kind of a quick general overview for folks that may not know.
Yeah. Great question. So conventional is your normal Fannie Mae, Freddie Mac market. That's where the most average loan is sold in the secondary market, along with your government loan products. That is what you hear right now. The Fed is buying loans. Those are the types of loans that the Feds are buying. Government and conventional loan products. Those are it. Government and conventional. When you hear of frozen assets or the jumbo space freezing, those are jumbo loans. So here for us in San Diego, that's anything over $701,500. Anything over that value is going to be considered a jumbo loan or some type of portfolio loan. Those secondary markets where those loans get sold have frozen, meaning they're not going to provide any new financing for that. So for today, Jack, to answer your question, has it changed anything with purchase on that end? We can't really originate a new jumbo loan as of right now because those investors have frozen those assets. Those investors froze those assets for those specific reasons, JR. They don't want to make any decisions in this market by providing this type of financing anymore without knowing how we're going to come out of once consumers go back into spending, once the Fed has really, opened up that space again for us. So the secondary market for jumbo investors have just decided to freeze their assets unless they're a federally insured bank. like the big banks who are, so they're able right now to produce jumbo loans because they're backing their own investment. The investors in the jumbo space that back, say, loans like Loan Depots or Quicken Loans, they've all held and frozen their money and waiting for the next pivot. Now,
okay, that makes sense. Now, I got. Sorry, I was going to ask you. Well, that's what I was going to ask you about the conforming space, because I've heard that there's been some change to the qualification requirements for folks in the conforming space. And then also, just to clarify, the government-backed loans, that's the VA and the FHA loans, correct?
Yep, government is VA and FHA loans, correct. So just like the jumbo lenders, right, are going to be freezing their assets right now, or the jumbo investors are freezing their assets, the conventional lenders, right, are going to be changing the way that they originate now, because we are in a different market. It is a little bit riskier of a market because we don't know the outcome yet. So it's risky because we don't know how we're going to land. Our home price is going to stay at the same level. In San Diego, we absolutely think so, from our opinion. Now, if for example, if conforming is going to change, right, or investors are going to change on the jumbo space, Conforming and Fannie Mae are going to change as well. Government is going to change as well. The feds are going to change this for us. So what ultimately you're seeing happen is that they're not making changes to their own loan rules and restrictions currently, but the lenders, Loan Depot, myself, we're putting overlays, or what are called additional guidelines, on top of these loan programs for safety measures, because we don't know where this market's going to go. We have to have a certain amount of reserves and money for each type of loan that we produce. So we have to be able to be smart and pivot and make the right decisions with how many loans we keep. Ultimately, we're now changing some of the guidelines for before. To give you an example, JR, we were at a 620 FICO score requirement on a purchase for VA. I believe we're now at a 660 FICO score for purchase if you want to be putting 100% down. If you're below 660, we need you to put 10% down. The VA rule for that is that you should be able to do 100% financing up to about 580 in FICO score. There's actually no overlay in VA. There's zero overlay on doing a loan. You can have no FICO score and do it. But the lenders like ourselves put these overlays, and before the average is about 620, and now our own company has it up to about 660. And that's just for the added risk in this type of market.
So, but that's specific to Loan Depot, right? So correct. Maybe other lenders have different. Are you hearing that other lenders are also doing similar type restrictions, or is that just mostly you guys on a more conservative basis? Or
yes, I like to think that we do take a little bit more of a conservative measure here at Loan Depot for our clients. However, this is the national average. This is the norm now for every lender going forward. Mostly, yeah, they're all making these decisions on the secondary market.
Now, I know that the government's buying up a bunch of the loans in the conventional VA and FHA space on the secondary market. So what's causing that, I guess, risk-adverse overlay to be added? Like, why is that being added when the government's buying up a lot of those loans, even though investors are not?
Well, in this market, investors stopped buying loans. So when this all started to happen, that's the reason why the government needed to step in and start spending on a larger front, was to keep the prices of these mortgage-backed securities. They needed to raise the price. They needed to start buying these a lot more so that interest rates stayed at the level that they were at. If, let's say, for example, the feds didn't, right? So when all this happened in the beginning of March, investors stopped buying. That's why the Fed had to step in to make these decisions to kind of keep the market moving the way it is, at least now. Once we go back to a normalized period of time, once we have a little bit more information on COVID, on maybe a possible vaccine, or we get people back to spending here, especially in California, once we get that normalized market, you're going to see investors come back and the Fed slow down their spending again. Investors take over that space, the Fed will start pulling out of that space again. But all the investors are out, so the Fed had to come in hard for the big punch.
Got it. So, well, speaking of your crystal ball, since you've got it out now,
Very Habib is my crystal ball. So we should
Yeah, I
all
mean,
be
I
watching
can
him.
share our perspective. I've been doing my own fair amount of research. I'm fairly obsessed with the whole everything going on because I'm kind of an econ nerd myself. But I'm always curious to hear other people's perspective because everybody's perspectives come from their own unique paradigm. You know, you being in the lending world is different than us being in the real estate world or somebody in the biotech field. So being in the lending world, from the rumblings and things that the information that you have to gather an opinion from, how do you see how do you see the markets? What do you feel like the timing is going to be? I mean, be it good or bad. I mean, whatever your true opinion is, what do you feel like? How is this going to play out, and according to what you're seeing?
Yeah, my opinion, Jack, has changed fast over the last 3 weeks, and it keeps going back and forth because every time I turn on the news, there's a new piece of information too. So beginning of March, I truly think this is going to be more of a rubber band type effect. I think that summer months, once we have the COVID situation dialed in a little bit more, understanding of vaccine or how we can handle, with ventilators and people here in San Diego and how our market's affected, I do think this is going to be more rubber band. I think our economy is going to fire back up. I think we're going to be able to get the investors right back into the spot where they were buying jumbo loans so that people like myself can originate from big market here in San Diego. I mean, the average home price in San Diego, I don't know that. You could tell me that, but I can tell you there's a lot more jumbo now. So there's going to be, we need that jumbo space back. And I know that the economy wasn't the one that caused, this problem. This was a public health problem, not a financial institution problem like it was in 2008, 2009. The banks are stronger than they ever were. We have more reserves than we ever did, and we have more money to lend than we ever did before. It's now the investors that said, hey, we can't make these moves until we understand, are people going to have their jobs to pay us back right now? Are they going to be able to make their mortgage payment, right? Things like that. So I do believe once the public health crisis is solved, or we have a better decision on how we can handle that, I think then we're going to have our economy back, and it should be a more short-term rubber band effect.
And JR, you spend a lot of time talking with customers about home purchases. What's your sense from what you're hearing with the folks that you're working with as to what people are thinking about the markets right now?
I think there's definitely been a drop off in the number of buyers we're seeing. And if I had to put a number to it, probably around, 25% or so of buyer activity. And a lot of folks are doing like the investors, just kind of sitting on the sidelines, waiting to see what's going to happen. So they're not saying that they're no longer interested in buying a home. They're just like, hey, I don't know what's happening right now. So with all the uncertainty, they're just kind of sitting tight. So that kind of makes me think too, as well, once the economy comes back to life, that there'll be a bunch of folks sitting on the sideline ready to take action. And with the interest rates as low as they are, that's definitely keeping the ones that are motivated shopping. So there are still buyers that are buying. There's still sellers that are selling. Homes are selling, I would say, almost as fast as they were selling before, because we had such a high level of demand and a low level of supply. So the fact that we've lost about a quarter of the buyers or so really hasn't made a significant difference when you're trying to sell a home just yet. It may take a little bit longer to find the right buyer. You may have to take a slightly lower price if there's not as many people competing, but still for the right homes, we're seeing, multiple offers, 5 to as many as over 10, depending on the price and the condition of the home. And so it's kind of, right now, I would say the best homes are getting a lot of activity. The ones that aren't prepped well, aren't presented well, those are the ones that are sitting on the market as duds and extending and having extended time on market, and eventually end up having to take much lower prices in order to sell.
Yeah. Interestingly, Garrett, on the same line of what you were saying before, as people sit on the sidelines, there's like a compression. All the people who are intending to act during these first few months of spring, your March, April, now probably our May people who are sitting, and if JR is right, that 25, let's say 25, and I'm throwing numbers up, let's say 25 to 50% of people who normally would be acting now put it off until, say, June. And then all the people who normally would be acting in June, plus all the people who intended to act in April, March, April, May, all those people come to market in June, July, August, and inventory is still light and rates are better than they ever been. I know from an economic standpoint that there's the market's not just going to snap back and one day miracle's going to be there and everybody's going to have their jobs back. But it is going to start moving, and its purchasing is going to be very, very attractive come the moment that we can see the light at the end of the tunnel. We may not be at the end of the tunnel, and I don't think we will be for another 12 months. But, I personally, from all the economic research stuff that I've done, has led me to come to the belief that we're going to have a really compressed, very overheated market come June, July, August. The folks that have their jobs and realize that this isn't going to end the world or the economy, particularly here in San Diego. I know there's other markets coast to coast that were already having a slowdown, but that's not consistent with what we were seeing here. We were seeing, multiple offers, meaning 10, 15 offers per regular demanded property right up till mid-March. And to see that, what we call a slowdown from being 20 offers on one property coming to market to being 5 offers in on one property is a big slowdown. But certainly from an economic standpoint, we need a lot more inventory on the market. We need more sellers than ever, and the demand still is present today. And I imagine even at the end of this, my hunch is it's going to be overheated, which kind of leads to, my recommendation in conversation with clients has been to act now ahead of everybody else, because that's where the opportunities exist. They talk about, it's very difficult to act when everybody else is on the sideline. But the truth is that's where the opportunity exists, is not in the herd mentality, but acting outside of the herd. So that's kind of been my coaching. I don't know who's listening or how many people are hearing my message, but I suspect that's going to be that's going to be where the money for folks is going to be made and acting in the next 3 weeks, 4 weeks, really.
Yeah, I think you're absolutely correct, Jack. 100%. We're going to have a much larger purchase business come these summer months because of all the people that were on the sidelines waiting to see what the Fed and the government were going to do. And let's bring this fast forward. Let's say, right, the Fed does open up consumer spending, right? That pizza employee can now go back to work, right? So then I can go pay that pizza employee his tip. That business owner is going to get paid for his food. He can make his mortgage payment. There's confidence back in this market. As soon as there's confidence back in this market, people are going to be jumping back to get in because what's low? Interest rates are low. Affordability is here in San Diego. We have it. We have large purchase prices with low interest rates. We're going to be able to meet demand. I mean, we won't have the supply for it, but we will have a lot of demand here in San Diego for it. Yeah. So I think you're 100% right. I think the people that are sidelined waiting right now, not confident that that people are going to go back to work. I mean, there are people still working right now. It just doesn't look like it either. That's another thing that we're not seeing, is that there are tons of people working. They're just not in their office anymore, or they're not at their restaurant anymore because they can hold their restaurant open just with a little bit smaller of a staff, right, at this current time, and just do delivery orders. So we're going to see people coming back to work, getting back into this space, and there's going to be a big purchase market in summer. I think and with the lowest interest rates in history, we've never been in this, so we're going to be ready.
Yeah, well, hold on. It seems like it's going to be a ride. Anything else you had that you'd like to add, JR?
No, I think you covered it well. Oh, you know what? I did want to ask one thing. Talk a little bit about your jumbo alternative option. Since I know we're worried about the jumbo space, San Diego has a lot of jumbo buyers. Just briefly mention your jumbo alternative option.
Yeah. Right now, if you guys were to bring, say, a jumbo client to us right now, I'd be advising them on 2 things. One would be, all right, this is the right opportunity for we identify that it's the right time for you to buy. So that's 1. And 2, the option, if the jumbo financing is what he needs, we're going to do 2 things. Look at if a first and second combination between a conforming first loan and a second home equity line of credit, which we can add those 2 together. And home equity lines of credit right now are at the all-time lows as well. on interest rates. So adding those two together will get you the financing you need for that larger jumbo price. We can still do those two loans simultaneously together. But I think, JR, as soon as we start doing this in a month where we're pre-approving clients for a first and second combination, we could, by the next week of that month, get our jumbo financing back and it be in a better position than what we were just approving them for. So that's what I could see happening, right, as confidence comes into this market.
Cool.
Amazing. Good. Well, it seems like we're in good hands with you, Garrett. I appreciate all the information that you're sharing about the markets and your insights about the loan process, and get in a lot of loan applications, get as many refis in as you can, man.
Thank
Congratulations on all your success.
Thank you, Jack. I appreciate it.